Hello, welcome to our webinar on the 2024 presidential election and your money. I'm Tony Marlette Jr., advisor at Brookside Tax and Financial Group. You may be asking yourself, why would we want to tackle such a subject? And the reason being, we've probably had clients over at least the last year, maybe even 15 to 18 months now, asking us in some way how this election is going to affect everything from the economy to taxes and to the markets. And it's almost as if we ask these questions and we have these conversations in passing. So as if a short answer would suffice. So wanted to take a look at some details today. Obviously, elections, issues, and candidates are always very polarizing. Now, we all have our values, our beliefs, our views. I do too. My goal today is to make this as nonpartisan as possible. We're going to take a look at the policies of the two major political candidates, Donald Trump and Kamala Harris, and how these can affect your retirement, the economy, taxes, and the market. The sources that we used include our partners, Stonewood Financial and Gradient Investments. We also used data from Kiplinger Tax and the Penn Wharton Budget Analysis, and of course, the comments publicly and the information on each candidate's website, which obviously is very partisan. One thing to keep in mind, remember that Congress passes laws for the most part, not the president themselves. But when we have narrow margins and what's projected to be narrow wins one way or the other, we tend to see less extreme regulations being passed on either side. In this particular election, if we look beyond the presidential part of it, all 435 seats in the House of Representatives are up, which Republicans hold a slim majority, and 33 of the 50 seats in the Senate, which Democrats hold a small majority, are up for grabs. Almost every projection that you can find says that this is going to be a tight race, and it's a very close field right now. Whenever we talk to our clients about ramifications of this, what type of risk are involved, people usually think of one thing, one risk, and that's market risk. And they're not wrong. Market risk is very important in retirement, especially at the beginning. We're going to take a look at two bigger, more important types of risk. And we're referring to tax risk, which is, if you think about short-term versus long-term, your tax bracket in your working years, or as we know it now, versus what it might be in retirement. And when we talk about legislative risk, the risk that anything can be wiped out with the stroke of a pen. So what's taxed? How much of it is taxed? When is it taxed? These are far bigger risks than market risk to your retirement. It does not necessarily mean you shouldn't be concerned with market risk, but to some degree, market risk is avoidable. Legislative and tax risk are not. If we look at the government as a business or as a household, we all know that the government takes in money through income taxes. In the last fiscal year, the government brought in $4.4 trillion. A lot of that, the vast majority of it, is due to income taxes. Now we have two types of expenses. This goes for the government, a business, or a household. The two types of expenses are non-discretionary, meaning the payments that you have to make. So in your household, think of mortgage or rent or your utility bills. And then discretionary expenses, meaning lifestyle expenses. So entertainment or travel or that extra car or the lake house, whatever that may be. The government has those types of expenses as well. So they're non-discretionary expenses, meaning the expenses that are not up for debate, not up for a vote. Most of them including large entitlements, just like you would imagine Social Security and Medicare, non-discretionary spending by the government in the last fiscal year was $4.4 trillion. Now, I did not just repeat the same number and misconstrue that. That's correct. The government took in $4.4 trillion in tax revenue and spent $4.4 trillion in non-discretionary spending. Now, the government, just like a business, just like households, does not exist just to pay their bills. They had discretionary spending, meaning projects, and believe it or not, military and infrastructure is included in discretionary spending, of $1.7 trillion. So to do the math on that, you had $4.4 trillion in income, $6.1 trillion in expenses, for a deficit of $1.7 trillion. So not many businesses, not many households would be able to survive if you had that type of deficit. Some people will say, well, you know what, we need to stop the spending, or we need to rein it in. Unfortunately, that's just not going to happen. For those of you who follow our podcasts and participate in our town halls, you've heard me reference before the U.S. debt clock. USDebtClock.org is a website that tracks government spending in real time. The ticker is always moving. Right now, our deficit is $35 trillion, which is 124% of our gross domestic product, or GDP. To put that in context, back in 1984, then President Ronald Reagan said that 35% of our GDP being debt was an eye-opening emergency. 35%. This was seconded by Delaware Senator by the name of Joe Biden. And what that tells us is 124% of our GDP being debt is not sustainable. So we talked about stopping spending and potentially slowing spending down before. Very unlikely for that to happen. The problem exists on paper. So we have a little bit of an income problem here. With a rapidly aging population, meaning less people in their prime working years, decreasing rate of childbirth, we're not having the income from taxes to fund such a deficit. And this kind of summarizes the Social Security shortfall as well. Now, on the Social Security website, on the government website, ssa.gov, there's a warning on there that talks about a potential downfall or a potential shortfall of funding for Social Security for those that apply for benefits initially beginning in the year 2034. So they project, as things are now, if you apply in 2034 or later, you're expected to see a shortfall, meaning you will not receive the benefit that's on your statement right now. There's also a concept that some people used to think of as extreme, which is known as modern monetary theory. This is not to be confused with modern portfolio theory, which is the theory that diversification and asset allocation actually reduce your risk. Modern monetary theory states that since the US prints their own currency, we can literally just print money, spend it on anything discretionary, and not worry about the national debt. Now, again, this used to be thought of as extreme, and in some corners, this is still being talked about in Congress. And to some degree, this is being practiced right now. If you think about the last 4 presidents, since the beginning of the 2000s, have spent more total than their 42 predecessors combined, even when you factor in inflation. My question about around modern monetary theory has always been, if we can just print money and use it to fund projects, Do we still have to pay taxes? I think we all know the answer to that. So speaking of taxes, let's take a look at the Trump campaign and their view on taxes. So the staple of the Trump administration from 2017 to 2021 may have been the Tax Cuts and Jobs Act of 2017. Of course, this was sweeping financial regulation that included a higher standard deduction, lower tax brackets, and this is for people, taxpayers, and businesses, small and large as well. It also raised required minimum distribution age for people to have to withdraw from qualified accounts. This was regardless of tax bracket. He wants to make these permanent, keeping the taxes low, stimulating the economy, driving earnings, and then driving the market. We'll talk a little bit more about that in a minute. A lot of what we saw before the COVID-19 pandemic wiped everything out. As for the Harris side on taxes, they want to extend some of the Tax Cuts and Jobs Act that would benefit low to moderate income households and sunset or retire the ones that would benefit high income or high net worth households. They've also talked about taxing unrealized capital gains for some people, presumably those who earn $400,000 to $500,000 or more in income. And we'll talk more about that in a minute. So we talked about the Penn-Wharton budget analysis when we talked about our sources before. So the Penn-Wharton budget analysis is a nonpartisan research initiative, and right on the front of their website, they ran a couple of hypotheticals. They do this often for presidential candidates and for issues. Their analysis, they took a look at the Trump tax plan and the Harris tax plan. They looked into their crystal ball and they extrapolated this out 10 years and said, okay, if either of these are put into place, what is this going to look like? So for the Trump tax plan, it would increase the national deficit by $5.8 trillion over the next 10 years. It would net out at about $4 trillion after stimulating the economy and growing GDP, and it would lead to, per their projection, better household income and a higher net worth for all brackets. As we mentioned, gross domestic product, GDP would be higher. There would be less revenue for the government. As for the Harris tax plan, it would increase the deficit by $2 trillion over the next 10 years, and low to moderate income household wealth would increase, and high income earners or high net worth individual wealth would decrease, and it would produce more revenue for the government. So we talked earlier about those that earn $400,000 to $500,000 a year. This seems to be the magic number whenever there's been talk of tax hikes. And the Biden-Harris administration has talked about if they do raise taxes, it would be on those earning $400,000 to $500,000 or greater. So presumably, capital gains would be taxed excessively. Unrealized capital gains would be taxed to those incomes in excess of $400,000 to $500,000. The study that was done took a look at a hypothetical. No candidate is proposing this, just to be clear. But the hypothetical said if you propose a 100% tax on any income above $500,000, it would get our national deficit down to about $600 billion. So we're still not even close. No candidate will ever touch Social Security or Medicare. Before their sentence is even over, their political career would go up in smoke. So we have a rapidly aging population as well. So from the 2010 to the 2020 census, we had more people aged 65 and over than anywhere else on the globe. So from 2010 to 2020, that increase outpaced anybody else on the planet. This means a couple things. One, there's more Social Security being spent And two, there's less tax revenue coming in from people in their prime working years. So what could be left for the government to do here? Well, they could look at targeting retirement savings. And if you think this is extreme or it's not real, here's an example. It's very real and very recent. For those of you who remember the Build Back Better legislation from Biden-Harris within the last couple years, part of that legislation was to wipe out a strategy known as the backdoor Roth. And a backdoor Roth is basically the ability for a high income earner who cannot contribute to a Roth to contribute to a non-deductible IRA up to the contribution maximums, convert that money over to a Roth, and they wanted to take that out. So that was part of one of the many provisions within Build Back Better. Build Back Better did not pass, and they scaled out, they stripped out some of what was in there, repackaged, repurposed it as the American Rescue Plan, and it passed. Absent from the American Rescue Plan was putting the backdoor Roth on the chopping block. So just to be clear, backdoor Roth is still allowed. It's still legal. Many people use it, but this is just an example of how these policies and these tax benefits are not etched in stone. These can be changed with one stroke of a pen. So a couple of other things that we'll look at here on finances and the economy. Not a lot of details on some of this, as you might imagine. You know, we've taken a look at what the candidates have said publicly and what their websites say. And there's not a lot of detail on some of these other things. So if we start with the Trump team, they want to slow the effects of inflation, meaning offset some of the spending that they know is going to happen by reducing some regulatory burdens, especially in the healthcare industry. Now, with the healthcare industry, there's been some incentives for people to leave. They want to take away some of those incentives, disincentivizing workers from leaving, which cause worker shortages, which increase costs. And as we all know, medical costs are the biggest cost for any retiree to absorb. We talked about the Tax Cuts and Jobs Act. They want to make that permanent, which would lead to large general tax cuts for everybody. And then there's a proposal for new federal land for home construction. On the Harris side, she's talked about putting government price controls on two big ticket items being rent and groceries, and also a program for first-time home buyer assistance for those who qualify of up to $25,000. A big hallmark or a big event that's been kind of in limbo over the last couple of years has been student loan debt. So she's talked about ending student loan debt and making college more affordable. Student loan debt forgiveness really has gone back and forth. Even recently, the restrictions were removed by a federal judge. So the thought was that some of this student loan forgiveness could go through, only for another federal judge to shoot it all down. And that's been very recent. So this has been going back and forth a lot. Previous restrictions were originally allowed to sunset, so you can see the back and forth on this. The Supreme Court has gotten involved. Congress has obviously been heavily involved as well. One other thing that she's talked about is expanding Medicare to cover long-term care costs of low to moderate income households. They would do this and they would fund it by making up for it without having to impose higher taxes with the breaks that they're getting from negotiating drug prices. So I've been in this business since 2005, and that crosses 4 presidential campaigns. Every single one of those campaigns has had somebody, whether it's a client, a lot of people actually, who have said something along the lines of, I'm not investing until fill in the blank is out of office. I don't trust this person. I don't want to invest in the market if this person is president. There's been plenty of people who have projected doom and gloom. If we just take the last two presidential administrations, the Trump campaign and the Biden campaign, the markets were up 61% during the Trump years, and that includes the COVID-19 drop, and 65% so far during the Biden administration. Again, many people have gone and projected doom and gloom for each, and even though it's true, markets are ruled by fear and greed, it's good to see that the underlying rule has always been markets follow earnings if they're rational. Markets are not always rational, but a rational market will always follow earnings. An efficient market will always do that, and we've been seeing that, and we expect it in general to continue. There was record inflation that was caused by government spending both during and after the COVID-19 pandemic. I don't think that's lost on anybody. So some deeper things that each side wants to get into. We'll just take a look at some brief topics from each side as far as what they want to accomplish. In general, Republicans want to repeal the estate tax and the generation skipping tax. If they keep the Tax Cuts and Jobs Act of 17 in place, which they want to do, they will keep that estate tax exemption at $13.6 million versus allowing it to revert back to $7 million where it was in 2017. We do know that Donald Trump has endorsed both of these positions. As for the Democrats, they want to lower estate tax exemption to $3.5 million and reduce that gift tax exclusion to $10,000, which is currently, as we mentioned, $17,000. A lot of people think of the gift tax exclusion if you think of 529 contributions for state accounts. Technically, there is no maximum contribution to a 529, but if you contribute over $17,000, which is the gift tax exemption, it eats into your lifetime maximum, which right now is $13.6 million. So it's unknown right now if Kamala Harris endorses any of those, or another talking point has been to raise the top tax rate to 55 to 75%. Again, unknown if Harris endorses either or any of those positions. So we talked about market risk. It's obviously big, but legislative risk and tax risk cannot be completely avoided. They're very underrated. Market risk is big, especially in the short term. So volatility can be expected. It's almost imminent. Do not react to that alone. Your best bet is to work with a team of advisors and keep an open mind on any recommendations that are made to optimize, not to perfect your situation. Remember, the old adage, the only things certain in life are death and taxes. Nobody can probably, in all honesty, nobody can probably help you avoid taxes altogether. A team of advisors that knows how to navigate taxes, changing laws, and income plans will be able to work with you, especially, again, keeping in mind some different recommendations that can be made. If you'd like to review your situation with us, of course, feel free to do so. You can call us, 440-886-3550. Visit us online at brooksidetax.com or stop into our office. If you have any questions on this webinar, please feel free to call or get in contact with us. I'd love to hear from you. Thank you for your time today. I appreciate your attention.